Picture this. You're lying awake at night, worrying about how to pay off your mortgage before retirement. Meanwhile, millionaires over 50 are taking on more debt elsewhere in America. Sounds counterintuitive. We've been taught that debt is evil, something to avoid like fire. Pay off everything, live debt-free, that's supposed to be the safe path. But the truth is, the wealthy quietly laugh at that advice. They know how to use other people's money to multiply their wealth, while most people only play defense, saving every penny and hoping it's enough for their later years. At 50 plus, you're at your peak. Stable income, solid credit score, and hundreds of thousands of dollars in sleeping assets you haven't yet tapped into. I believe debt is not the enemy, it's a tool. The question isn't whether you have debt, it's whether that debt is taking money out of your pocket or putting more money in. Linda, 55, from Florida, once thought debt was only a burden, but with the right strategy, she turned her loan into investment capital, boosting her cash flow by over 25% annually. And today, I'm going to show you the exact 5 steps the wealthy over 50 use to turn debt into a wealth-building machine. Step 1. Know your net worth. Before the wealthy even consider borrowing another dollar, they always start with something simple, but few people do. Calculate their net worth. This is the foundation for knowing what tools you have, so that you can use them as financial leverage. If you don't know precisely what you own, you can't fully maximize the power of your assets. It's like holding a deck of cards without realizing you've got the aces. Firstly, determine the value of your home. Don't guess. Go to sites like Zillow, Redfin, or Realtor.com, enter your address, and check the latest valuation. I've seen people who thought their house was worth only $250,000, but when they checked, it was $380,000. That difference represents untapped borrowing power you never considered. Next, add up all your retirement accounts. 401, IRA, Roth, IRA. Even if you can't directly borrow from them, except in certain cases, banks will consider your total assets when determining your loan interest rate. Your retirement accounts are part of your overall financial picture. Thirdly, check your credit score. By age 50 plus, if you've managed your money well, you have something younger people envy: a long, solid credit history. This is gold when it comes to securing low-cost financing. You can get free credit reports from all 3 bureaus, Experian, Equifax, and TransUnion at annualcreditreport.com. Finally, analyze your monthly cash flow. You need to know exactly how much comes in, goes out, and is left over each month. This will help you determine your capacity to take on new debt. If you're nearing retirement, forecast how your income will change so you're not caught off guard. I once met Michael, a 52-year-old engineer from Denver. He always considered himself not wealthy and not ready to invest. But when we sat down and calculated, we found a $500,000 home with a $150,000 mortgage, $350,000 in retirement accounts, and a 790 credit score. His total potential borrowing power exceeded $700,000. From thinking he was getting by, Michael realized he was sitting on a financial goldmine. Most of us don't lack assets, we lack accurate information about our assets. Once you know your true worth, you'll have more confidence in every financial decision, from negotiating with banks to choosing your next investment. The wealthy treat their net worth statement like entrepreneurs treat a profit and loss report. They don't avoid the numbers out of fear of facing the truth. Instead, they proactively update and optimize them. This is the first step in turning debt into a tool for building wealth, rather than a burden. Step 2. Hunt for cheap capital. This is where the wealthy think completely differently from most people. While many in their 50-second focus on paying off all their debts to be debt-free before retirement, The wealthy actively seek out sources of capital with interest rates lower than the returns they can generate. For them, cheap money is a golden opportunity. They take full advantage of it before market conditions change. If you can borrow at 5% and invest for a stable 8–10% return, you are essentially getting paid to borrow. The real question isn't, should I have debt, but is this debt making me richer or poorer? Your home is often the cheapest source of capital you can access. If you bought it 15–20 years ago, you're likely sitting on hundreds of thousands of dollars in sleeping home equity that's not making you a dime. Through a cash-out refinance or a HELOC home equity line of credit, you can unlock that equity at a low interest rate, sometimes even tax-deductible if used for the right investment purposes. For example, Karen, 59, from Texas, was proud to have paid off her home. However, when we analyzed her finances, we found that she had $400,000 in unused equity. Karen decided to open a $120,000 HELOC at 5.6% interest to buy 2 short-term rental cabins. After covering all operating costs and interest payments, she still netted $900 a month. Many brokerages offer securities-based lending, borrowing against your portfolio as collateral if you have an extensive investment portfolio. The advantages: you don't have to sell your stocks, avoiding capital gains tax. You still benefit if they rise in value, and interest rates are often very low. However, be aware of the risk of a margin call if your portfolio value drops significantly. SBA loans, Small Business Administration, are an excellent funding option for running or starting a business. They offer low interest rates, long repayment terms, and partial risk guarantees by the government. Many entrepreneurs over 50 use them to expand or diversify their businesses without putting personal assets at risk. Golden rules for hunting cheap capital. Number 1. Compare borrowing costs to expected returns. If the cost of capital is higher than the safe returns you can generate, skip it. Number 2. Only borrow for cash flow generating assets. Don't borrow for consumption, buying cars, or vacations. Number 3. Plan for worst-case scenarios. For example, if income from your asset drops by 20%, you must still be able to cover loan payments. Many people miss opportunities because they are obsessed with being debt-free. In a reasonable interest rate environment, cheap capital is an excellent lever to increase asset accumulation. But cheap money is only truly cheap if you use it to generate steady, long-term cash flow. Otherwise, it becomes a financial burden just like any other consumer debt. James, 56, from California, had a $600,000 stock portfolio. Instead of selling stocks to buy real estate, he borrowed $150,000 at 4.8% interest from his brokerage to use as a down payment on a 6-unit rental property. After all expenses, the net income from that property was $1,400 a month. Meanwhile, his stock portfolio continued to appreciate and pay dividends. When you master the art of hunting for cheap capital, you realize that money doesn't just come from hard work or saving. It comes from knowing how to leverage the resources you already have at the lowest possible cost. And this sets the stage for the following strategy: using borrowed money to buy income. Not things the secret that allows the wealthy to turn debt into a never-ending money-making machine. Step 3. Buy income, not things. This is where the thinking of the wealthy and most people takes 2 completely different paths. When most people get access to a loan, their first thoughts are about upgrading their house, buying a new car, or going on an extended vacation. But the wealthy ask, how much monthly income can this money buy me? They use borrowed capital to purchase cash flow generating assets that bring in more each month than they cost to own and operate. This way, the loan pays for itself and produces profit, instead of pulling money out of your pocket. Rental real estate is one of the most common tools. You buy a property where your total monthly costs, mortgage, taxes, insurance, maintenance, are $1,800, but you rent it out for $2,500. The $700 difference is your monthly net profit, not to mention your tenants are paying down your mortgage for you, increasing your net worth over time. Mark, 54, from Ohio, used an $85,000 HELOC to put a down payment on a 4-unit building worth $340,000. Over 8 years, in addition to earning over $900 a month in cash flow, he gained nearly $180,000 from property appreciation and mortgage paydown. It's not just real estate. Dividend stocks are another great option. If you borrow $100,000 at 5% interest, costing $5,000 a year, and invest in stocks yielding 7%, $7,000 a year, you've just created $2,000 in passive profit, not counting potential stock price growth. The wealth flywheel strategy. The wealthy don't stop at one asset. When an asset's value increases, they refinance or pull equity out, cash out, to buy another asset. Each cash-flowing asset helps pay for the loan and funds the purchase of more assets. This cycle works like a flywheel. Every rotation generates more momentum for faster growth. Many people fail because they can't distinguish between liabilities and assets. No matter how beautiful, a brand new car loses value when you drive it off the lot. In contrast, a cash-flowing asset holds or increases its value and consistently puts money into your pocket. Rules for buying income. Number 1. Calculate net cash flow after all expenses. Include loan payments, taxes, insurance, maintenance, management fees, etc. Number 2. Prioritize assets with a stable income history. Don't rely solely on optimistic projections. Number 3. Ensure positive cash flow from day one. Avoid lose now, profit later deals unless you have a solid backup plan. When you focus on buying income instead of buying things, you build the foundation for true financial freedom. Each new income stream is like a brick. The more bricks you have, the stronger your financial wall becomes, ready to protect you from any economic storm. Step 4. Reinvest all cash flow. This is where the wealthy create the most significant difference compared to the majority. Once they have passive cash flow every month, most people treat it as bonus money to spend upgrading their car, traveling, shopping. However, the wealthy do the opposite. They treat every dollar of cash flow as a seed that needs to be planted again to grow more money trees in the future. Passive cash flow is not for spending, it's for reinvesting. This is how you turn a drip of income into a financial river. Build the income snowball. When you reinvest your cash flow, each profit cycle accelerates your asset growth. Like a snowball rolling downhill, the bigger it gets, the faster it grows. Example: Year 1, you own one rental property generating $1,200 month net after expenses. After 18 months, you use that profit as the down payment for a second property. Now you have 2 income streams totaling $2,400 a month. It only takes about 12 months to buy the third property. Susan, 57, from North Carolina, started with a duplex that brought in $1,000 month net. She didn't spend that money, she only put it into a separate account for reinvestment. After 18 months, she bought her second property, raising her monthly income to $2,200. In less than 5 years, she owned 5 properties, generating over $4,800 month, enough to retire early while continuing to invest. Ways to reinvest cash flow. Buy more cash-flowing assets, rental real estate, dividend stocks, high-yield bonds. Pay down investment debt, reduce risk, increase net worth, and free up cash flow for future deals. Build an investment reserve fund. Stay ready to seize underpriced assets or handle emergencies, repairs, vacancies, etc. The wealthy understand that growth without a shield is a double-edged sword. They always allocate part of their reinvested cash flow into protection, property insurance, emergency funds, and portfolio diversification to avoid relying on a single income source. I've seen two people start with the same capital and cash flow. One spent all profits to upgrade their lifestyle, the other reinvested relentlessly. After 10 years, the second person's assets were worth 4 or 5 times more, and their cash flow was so large they could spend freely without touching the principal. The difference wasn't in how much they earned initially, but how they used their cash flow. Rules for effective reinvestment. Number 1. Stay disciplined. Keep a separate account for passive income. Never mix it with personal spending. Number 2. Always have the next move ready. Before the cash comes in, know exactly how it will be used, what asset to buy, which debt to pay off. Number 3. Combine reinvestment with risk reduction. Always allocate 5–10% of profits to strengthen your reserve fund while expanding. Reinvesting cash flow is the catalyst that takes you from stable to financially free. Every dollar you reinvest today becomes multiple dollars tomorrow. This is not a flashy strategy, but it's the sustainable method the wealthy have used for decades to ensure their wealth grows steadily and protects itself against market fluctuations. Step 5. Protect your gains and avoid mistakes. Once you've used debt to buy assets, generate cash flow, and reinvest continuously, a dangerous temptation appears, the urge to speed things up even more. This is precisely when many people who were once successful stumble because they forget that keeping money is more complicated than making it. The wealthy understand this well, so they always have a strategy to protect their gains before considering the next move. Number 1. Avoid over-leveraging borrowing beyond a safe limit. Financial leverage can make you rich faster, but it can also make you collapse faster if abused. The wealthy always stress test their investments by asking tough questions. If income from my asset drops 20%, can I still make my payments? What if interest rates rise by 2–3%? Do I have reserves if the property sits vacant for 3–6 months? David, 61, in Georgia, bought 3 rental properties in a year, convinced that the market could only go up. However, when one needed a $15,000 roof repair and another sat vacant for 4 months, negative cash flow forced him to sell one at a loss to keep the other 2. The mistake wasn't using debt, it was using too much without a safety cushion. Number 2. Don't mix investment debt with consumer debt. This is a non-negotiable rule for the wealthy. They only use debt to buy assets that generate money. All personal spending, cars, travel, furniture, is paid from income or savings, never mortgage equity or HELOC funds. Using borrowed home equity to buy liabilities is like holding your house hostage for items that lose value daily. Number 3. Always maintain a reserve fund. The wealthy never put every dollar to work without a reserve force. A reserve fund covering 6–12 months of asset operating expenses ensures you can ride out rough patches without selling under pressure. Brian, 60, is in Arizona, owns 2 rental properties, and has $50,000 in cash. When one unit was vacant for 4 months, he could still make payments and handle maintenance without affecting his personal life. Number 4. Work with a team of experts. The wealthy don't try to do everything themselves. They built an asset protection team that includes financial advisor, aligns strategies with your goals and age. CPA, knowledgeable in investments, optimizes taxes from real estate, dividends, or capital gains. Asset protection attorney, creates secure ownership structures and separates personal from investment assets. I once saw an investor skip legal due diligence before buying commercial property and lose over $40,000 due to contract issues. A 2-hour legal consultation could have saved the entire amount. Number 5. Always invest with the worst-case scenario in mind. The wealthy don't pick deals just because they look good in the best-case scenario. They assume lower than expected returns, higher costs, and extended payback periods. If the deal still has positive cash flow in the worst case, it's worth doing. I believe protecting your gains is not about fear, it's about respecting the effort you've put into building your assets. At age 50 plus, the goal is no longer hit fast, win fast, but sustainable growth and financial safety regardless of market volatility. Use debt like a scalpel precisely, carefully, and with purpose, and it will be a lifelong partner instead of an enemy. Step 5 may not be as glamorous as hunting for cheap capital or buying new assets, but the steel fence protects your entire strategy. Skip this step. Everything you've built could vanish with a single setback. Master this step, and you'll grow richer. You'll keep that wealth for life, and even pass it on to the next generation. We've just gone through the 5 steps the wealthy over 50 use to turn debt into a wealth-building machine. 1. Know your net worth. 2. Hunt for cheap capital. 3. Buy income, not stuff. 4. Reinvest all your cash flow. 5. Protect your gains and avoid mistakes. The key isn't how much you borrow, it's the purpose of the loan. Consumer debt takes money out of your pocket. Proper investment debt puts money into it, month after month. At ages 50-60, you hold tremendous advantages: stable income, strong credit, and years of accumulated asset value. The right strategy could be your golden window to build true financial freedom. My view is, don't see debt as the enemy, see it as a partner. If you control it, it will work tirelessly for you. The most critical factors are discipline, careful calculation, and always having a backup plan. Now, I want to hear from you. Hear what untapped capital are you sitting on: home equity, investment accounts, or idle cash flow? Which of the 5 steps we covered today best fits your situation? Comment your answer below. I'll read every single one. If you found this helpful video, don't forget to like, share it with someone who needs it, and subscribe to the channel so you won't miss the following financial strategies. We'll dive deeper into upcoming videos covering tax optimization, asset protection, and portfolio expansion.